You know, it's not every day that just the mention of a single name for a job can send shockwaves through the entire global economy. It's incredibly rare, but, well, it just happened. Let's break down exactly why. The second Donald Trump even hinted that he might nominate Kevin Warsh to be the next chair of the Federal Reserve, the markets didn't just react, they convulsed. And that immediate, really powerful shockwave, it tells a fascinating story about what investors are expecting and what they're afraid of. So what happened? First off, U.S. stocks. They'd been climbing pretty steadily. But then, bam, they suddenly closed lower. And this wasn't just some minor dip. It was a really clear signal that Wall Street was bracing for a massive change. And it didn't stop there. Then you have precious metals. Things like gold, the assets people run to when they're scared. They went through a historic sell-off. That tells you investors weren't just shuffling money around. They were starting to fundamentally rethink what a safe investment even is. And while all these other assets were falling, the US dollar got a lot stronger. Now that's a big clue. It signals that the markets think a Fed led by Warsh would get super aggressive about fighting inflation, which makes holding on to dollars suddenly look a lot more attractive. So you've got all this chaos, stocks, metals, the dollar, all because of one person's name. It really makes you wonder, who on earth is Kevin Warsh? And what does he believe that has the entire financial world so completely on edge? To really get a handle on this guy, you've got to look at his resume. Because here's the thing, he's no outsider. He's actually a product of the very systems he now seems to want to tear down. I mean, his career path is basically a tour of the financial world's biggest power centers. He started out deep in the trenches of Wall Street at Morgan Stanley. Then he jumped to the White House to advise President George W. Bush on economic policy. And then, get this, at just 35 years old, he became the youngest governor in the entire history of the Federal Reserve. And he wasn't just warming a seat at the Fed. He was right there in the thick of it during the 2008 financial crisis, acting as the main go-between for Fed Chair Ben Bernanke and Wall Street. Bernanke himself praised his fortitude. So let's be clear, this is not an outsider. This is a guy who knows exactly how the machine works from the inside. Okay, but here's the big twist. Even with that deep establishment background, Warsh is now talking about a completely radical overhaul of the Fed. He's not looking to just tweak things here and there. He wants what he calls a total regime change. His whole vision is built on a few core ideas that basically fly in the face of decades of central banking. He says inflation is a choice, not some inevitable trade-off. He wants to stop the Fed from dropping hints about what it's going to do next, and he's proposing this controversial new partnership with the Treasury and a new America First style of banking rules. But his most radical, kind of head-scratching idea is this one. Right now, the Fed has two main levers, right? You raise rates to cool down inflation, or you cut them and grow the balance sheet to juice the economy. Warsh is arguing you can do both at the same time. Cut interest rates while also shrinking the balance sheet. He thinks the two moves can cancel each other out and create a whole new kind of economic stability. And this all gets to his main complaint about the Fed today. He uses this phrase, mission creep. He basically argues that the central bank has wandered way outside its main job of keeping prices stable, and now it's getting mixed up in everything from political debates to social policy. He wants a much leaner, more focused Fed that just gets back to basics. So, what do we call a guy like this? In the language of the Fed, people are usually put in one of two boxes. You're either a hawk or a dove. But with Kevin Warsh, well, it's just not that simple. So just a quick refresher so we're all on the same page. A hawk is tough on inflation, loves higher interest rates to keep prices down. A dove is more focused on jobs and growth, and is totally cool with lower rates to make that happen. Warsh's record is complicated, but there's one moment that really stands out. So it's November 2010. The country is still just reeling from the financial crisis. And in a Fed meeting, Kevin Warsh says this. He starts talking about the U.S. job market by mentioning how strong things look in his own very wealthy neighborhood. But the reality for pretty much the entire rest of America was devastating. At that exact moment, the national unemployment rate was 9.6%. That one comment, the contrast between his personal bubble and the harsh reality for millions, is a huge reason why so many people argue he's just out of touch with regular Americans and could never be considered a dove. Okay, so let's pull all these threads together. What would a Warsh regime at the Federal Reserve actually look like in practice? And why does it make the markets so incredibly nervous?
This table here really lays out the potential revolution we're talking about. The Fed's huge balance sheet, it would get smaller. The clear communication that investors depend on, like those dot plots that predict rate moves, yeah, that could just vanish. Global banking rules could get tossed out for an America First system, and the Fed's sacred independence might be challenged by working way more closely with the Treasury.
Now look, this isn't just some abstract theory for economists to argue about. This stuff has real-world consequences for you. A smaller Fed balance sheet could mean higher mortgage rates. A Fed that doesn't communicate clearly could mean way more wild swings in the stock market. Warsh also has this new idea that AI-driven productivity could let the Fed cut rates even if the economy is strong. But really, at its core, his entire vision is a fundamental test of the central bank's independence. So in the end, Kevin Warsh isn't just suggesting a new policy. He's pushing a whole new philosophy. And the markets are nervous because he's signaling a tectonic shift that could completely redefine inflation, interest rates, and risk itself. And that leaves us with the big question. Is his plan a bold, much-needed reset for the American economy, or is it a massive, high-stakes gamble with consequences none of us can predict?